We are everywhere.
Good morning. You're watching All You Need to Know on BloombergQuint Live, and I'm Alex Matthew. First, the headlines. Harvard University professor Kenneth Rogoff tells BloombergQuint that India has the potential to grow at 7 to 8% for the long term and says that China is clearly on a slowing trajectory. In earnings, Axis Bank's net profit misses street estimates owing to higher staff costs. Asset quality remains stable while slippages rise sequentially. Larsen & Toubro's bottom line manages to meet estimates in an operationally weak quarter. The infrastructure conglomerate has maintained its revenue and order inflow guidance for FY20. Jaguar Land Rover will cut 500 jobs at its Liverpool plant as the luxury car maker looks to lower costs. And China places Wuhan, which is the epicenter of the coronavirus outbreak, under a travel suspension. The death toll from the mystery illness has now risen to 17. Let's talk about the U.S. markets first. It was a mixed day of trade for the U.S. markets. Benchmark indices ended flat and off the highest point of the day. The S&P 500 and NASDAQ managed to eke out gains, while the Dow underperformed, dragged primarily lower by Boeing. Abigail Doolittle of Bloomberg News wraps up the trading action on Wall Street in this report.
Wednesday's Wall Street session turned out to be an interesting one. It started off pretty bullish. The major averages all higher, at one point up by about 0.5%, at least the S&P 500 and the NASDAQ, putting in all-time highs. But by the end of the day, it was a mixed session of very small moves. The Dow finished slightly lower, the NASDAQ and the S&P 500 slightly higher. It seems that at the beginning of the session, traders, investors not as worried about the coronavirus. By the end of the day, a little bit more worried, taking chips off the table. And that's really confirmed by the idea that the Dow transports down for a third day in a row. On Wednesday, down by about 0.7% over the last 3 days, shedding nearly 3%. Of course, that index containing airlines, among other components of the transportation sector, could be hit more if the coronavirus escalates in any sort of way. Confirming the idea that at the end of the day, it was a tad risk off, maybe neutral best case scenario. We did have Haven bonds rallying, even though the Japanese yen was lower. Sector-wise, also, sort of a mixed picture there. Mover-wise, lots of individual movers on earnings. But before we take a look at earnings movers, the big stock mover on the day, Tesla, at the end of the day, shares up about 4%, at one point up far more. The big news, though, on the day, catching a $100 billion market cap, crossing that threshold this year. Analysts pretty bullish, growing more bullish on Tesla. Lots of price targets for this stock. Moving higher, some even at $600 or above $600. So those shares really climbing on the day. Netflix, though, not so much. Those shares down by about nearly 4%, down 3.6% on a mixed quarter around subscribers. IBM up 3.4%, a solid quarter. Sales growing for the first time in 6 quarters, really helped out by the Red Hat acquisition in the cloud. J&J down a bit, down 0.7%, a mixed quarter there. Litigation and legal costs really weighing on those results. And then finally, in the post-market, the chip sector on the day really outperformed, up about 0.8% ahead of Texas Instruments reporting. That company did report right now. It's considered to be solid. Those shares climbing in the post-market trade, and it looks like guidance was brought a little bit above consensus. So again, overall, Wednesday's Wall Street session a bit mixed, neutral in terms of risk appetite, but one bright spot, the chips. From New York, Abigail Doolittle, Bloomberg News.
All right, so those are the cues that came in from the U.S. markets. Let's go straight and take a look at the Asia-Pacific region now. Sophie Kamruddin is joining us live from the Bloomberg studios in Hong Kong. Seemingly a risk-off tone at the start of trade today. Sophie, morning.
Morning, Alex. Looks like that recovery that we saw on Wednesday is short-lived, with Asian stocks resuming losses. U.S. equity futures marginally under pressure, while the yen is building on gains below 110, and bonds are broadly higher, with benchmark treasury yields edging closer towards 1.7%. But Australian bonds reverse gears, with the yield curve bare flattening and the Aussie dollar jumping as much as 0.5% after better than expected December jobs data from Australia, which has paired bets for an RBA rate cut next month. And turning to Chinese markets on the final trading day for the mainland before the Lunar New Year, the Shanghai Composite is under pressure, nearly off 1%. And here in Hong Kong, the Hang Seng is down 1% as well, giving back most of Wednesday's rebound. So the strain is showing amid concerns over the coronavirus outbreak. But Citigroup notes that there will be a smaller impact on Hong Kong's major stock gauges compared to SARS because of the lower fatality rate so far. But we are seeing anxiety also play out for now in other asset classes. Oil, for example, extending losses, with both WTI and Brent losing more than 1% this morning, trading at a 7-week low on anticipated impact on energy demand from travel restrictions. Back to you.
Thanks so much for that, Sophie. Now, let's talk a little bit more about what Sophie was mentioning, which is the coronavirus. The death toll in the coronavirus outbreak has now risen to 17. As a measure to curb the further spread of the disease, China has suspended travel to and from Wuhan city, which is believed to be the epicenter of the outbreak. On the other hand, the World Health Organization has delayed the decision to declare the outbreak an international health emergency, saying it needs more data to analyze the situation. Selina Wang of Bloomberg News has the latest.
The latest news is that they're going to be suspending outbound flights and rail from Wuhan city. They're also going to be restricting travel by bus and subway and ferry in that city. The death toll, as you said, now rising to 17. That's double the official number we knew from yesterday, and hundreds are infected, though the likes of Imperial College of London estimate that that number of infected people could be as high as 4,000. That's based on the number of known cases and the estimated time between infection and detection. Now, all those deaths are concentrated in Hubei province right now, but it has been expanding across China, Japan, South Korea, Macau. First cases in Hong Kong and Washington. Health officials are still trying to understand the pathogen, and there are fears that it could mutate and become more deadly over time. You also have the World Health Organization delaying that decision on whether or not to label this as an international public health emergency, saying that they need to gather more information and analyze the oncoming developments.
And Selina, we heard from the Vice Chairman of the Chinese Securities Regulator in Davos. He struck a pretty confident tone in terms of seeing a limited negative impact so far. Let's just take a listen.
Well, obviously it's a challenge, right? But if there's any country in the world that can deal with this kind of challenge well, it must be China. So I have no doubt that our government and the people will be able to deal with it in a timely and effective manner. And whatever damage it may have to the economy is going to be very limited.
And Selina, no doubt lessons have been learned from the way that SARS was handled 17 years ago. What have we heard in terms of the tone of other official responses from China?
Well, at the National Health Commission press briefing, we did hear a tone of confidence and trying to assure the international and domestic community that the Chinese government has it handled. They're trying to move swiftly and decisively. We have seen the government learn a significant number of lessons since the outbreak of SARS in the early 2000s, when they were criticized for trying to deny the scope of the problem, being very slow to respond to it. That event triggered a number of reforms in China. They set up the Center for Disease and Prevention. They've also since then invested some $12 billion yuan into upgrading that disease prevention system. So you did see China share the genetic sequencing of this disease very early on. They also are setting up now a daily reporting system showing that more information will be shared to the international community as well. In addition to this travel restriction, you also have the government stepping up quarantines, health screenings. It's banned wildlife animals from Wuhan, since it's believed that this pathogen originated from wildlife and human interaction. So this transparency is a big deal. It hasn't been perfect. You have netizens online in China who have been complaining for weeks that they've been waiting for this type of daily reporting system. But in terms of where they were back in the early 2000s, it's miles away.
All right, so that's clearly a big headline going to trade today or at the start of today. Let's take a look at what else is making headlines across the globe. Sue Keenan of Bloomberg News brings you the first word headlines.
We're going to start with the latest on the impeachment hearings. President Trump dominated proceedings over in Davos, lauding his economic achievements and attacking his political opponents back home, as well as deriding his impeachment trial home as, quote, a hoax. He also said he wants a trade deal with the European Union before the election in November, but raised the stakes by renewing his threat to impose auto tariffs if the bloc will not compromise in negotiations. President Trump's impeachment trial did enter its second day as House managers presented their case to the Senate. Now, the president has dismissed, again, the proceedings as a hoax. However, a new Pew Research survey says almost 2/3 of Americans believe he has definitely or probably done things that are illegal, either in office or during the campaign. To Malaysia now, the country unexpectedly cut its benchmark rate, becoming the latest emerging market to ease amid global economic uncertainty. Now, Bank Negara lowered the overnight rate by 25 basis points to 2.75%. Only 2 of the 26 economists we surveyed predicted the move. Elsewhere, the ECB is planning a new 2-part policy approach that separates inflation targeting, I should say, from its other aims. And to the UK, Prime Minister Boris Johnson's Brexit bill has cleared its last hurdle in Parliament, ending years of deadlock that has paralyzed UK politics since the 2016 referendum. Now, the passage vindicates Johnson's snap election last month, in which he asked voters to back his plan to leave the EU on January 31st. The bill now goes to the Queen, who will sign it into law, putting Brexit on track in 9 days' time. We shall see. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Sue Keenan. This is Bloomberg.
All right, on to BloombergQuint's coverage from Davos in Switzerland. India has the scope to grow at more than 7% for the long period. That's according to Harvard University professor Kenneth Rogoff. Speaking to Menaka Doshi at Davos, Rogoff says it's China that he's worried about. He also rules out the possibility of the U.S. economy heading into a recession. Listen in.
You know, I found a lot of my colleagues are hoping for a recession this year so that it'll affect the election. But I think the odds are slightly higher. Like in a normal year, there's a chance you'll have a recession, 15, 16%. Maybe this year it's 20 or 25%. And the odds of having a really deep recession, I think, are a lot lower than that, certainly in the U.S. I mean, in Europe also, their baseline is lower. So I don't know what you call a recession in Europe because 1% growth is normal. So if they go to minus 0.5%, that's a pretty small dip. I worry most about China because they're clearly on a slowing trajectory. Long-run growth in China is going to be much lower than it is today. The population's slowing. They have a horrible demography problem. Their catch-up with the West has slowed down. They've overbuilt in housing, which is their stimulus, on and on. And they're very good at dealing with problems. It's much easier to deal with a growing economy than a slowing economy. So, and another area I would highlight of being at risk are emerging markets in general, where there's really been quite an explosion of debt. Admittedly, a lot of it's private debt, but in these many countries where there are monopoly corporations, there are many companies, the distinction between government and private and government's not clear. So debt is going like this, growth is going like this, and it's, I think, a fragile situation. The World Bank did a report recently that called attention to that.
Would India figure on your list of countries that you're concerned about where we've had issues in the financial system, credit issues, higher debt, a lot of cleaning up in terms of corporate balance sheets, lots more to go, and growth that's slowing?
Well, I defer to my colleague, Peter Gopinath, who is now head of the IMF, and their forecast, which basically says the most likely is things will get a bit better, that there were reasons growth slowed down, ranging from the aftermath of demonetization to maybe more importantly, bumps in introducing the GST that will go away over time. The banking sector is certainly still a problem, but I think India, I'm probably more optimistic about than maybe many other emerging markets.
So I was speaking with Professor Fan Gang yesterday, and he said that China will continue to grow at in and around 6%, according to his assessment, for the better part of this decade. If India's growth doesn't move substantially higher than 6.5%, 7%, we're looking at two large economies from a population point of view growing at sub-7, sub-8% growth. What does that mean for global growth this decade? Not that India was a driver of growth at all, but if the U.S. is moderating for the next few years...
Well, I think India has the potential to grow at 7 and 8% for a long time. China does not. India has a young population. It has a lot of potential to deepen its infrastructure to catch up. China is at the other end of the curve. They're reaching the end of the line. And yes, Fang is very good, but they can't say anything different because that's what the leader says. I think everyone recognizes that the future growth over the next decade in China is probably 3%, 4%, the average over the next decade. Well, because they don't have population growth anymore. Their labor force is shrinking. They're much further along the technological catch-up curve, and they have a overbuilt housing, very centralized government. So I think China probably is not going to be contributing as much. But as India grows, it will contribute more and more. I mean, I think there's plenty of reasons to be optimistic that India can do better than 6%.
Right, that's part of a whole conversation. So you'll find it and all the conversations we're showing you on this program on the website BloombergQuint.com. Now, M&M is more like a federation than a conglomerate, according to Anish Shah, who is the CEO and the MD designate of the company. Speaking to Menika at Davos, he adds that he's not too keen to shut down or to list the different verticals separately and would rather focus on scalability.
I would first say that we are a federation, not a conglomerate. It's a very important distinction. And yes, I'm convinced on that, and part of my job will be to convince others why this is such a good model. As a federation, we don't get into details for operating companies.
Sure. Each one
so
is
we
listed,
operate,
most of them
each
are
one's listed from
most
a governance standpoint.
Boards and your own management.
Their boards run them as well. So we in some ways more like a Berkshire Hathaway from that perspective. The difference though is there are significant synergies across these companies. So when we look at sourcing, which is a big part of the cost for auto and for farm, if that's done together, that helps them reduce costs quite significantly. If you look at the customer, for example, a consumer coming in to buy a car. In many cases, a consumer would go to a dealership, look at a car, select a car, then apply for financing somewhere, apply for insurance somewhere else, and then once they have a car, there will be other need from a maintenance standpoint. If they have to sell a car, they have to go somewhere else to sell it. What we're looking at is, can we synergize to do this across all our companies and offer the customer a seamless experience?
But that's still just the car universe, right? What's the connection to holidays? Or what's the connection to real estate? Or affordable housing? Or logistics, right? Those are all group businesses. So there is no apparent, tangible connection within the various businesses. I understand you're styling yourself like a large private equity fund or like a Berkshire. But do you see big value in that in the decades to come is my question. You've said yes.
So let me give examples of that, okay, because that's the right set of questions. And you're right that there are some synergies that will be apparent for a consumer in a certain set of industries. Right. But let's look at your question around holidays and auto. Right? We were piloting an AI technology. We started with Club Mahindra Holidays for that. We were looking at AI to do digital marketing. I won't go into details of that in our conversation today, but that can really transform the way we can deliver value to customers. And the auto business, as I saw the results from holidays, took that and has deployed that today as well. So in the world today, we're going to see a lot of change happening very quickly. So our challenge is, how do we find best practices across our portfolio, be able to transfer them quickly. There will be learnings, there will be things that work, there will be things that don't work. And those are areas where if we are focused on delivering value, that comes back to, can we deliver value, can we win in the areas we play in?
Okay.
That's how we would do it. And as you rightly said, those questions do exist outside. And part of my job is to be able to show real examples of where the real value was added to enhance value for investors. And hopefully at some point we can move from a discount on a conglomerate model to a premium on a federation model.
Okay, so maybe one of two ways that I can think that might happen is that if you separate out your auto business from the main parent company right now, whatever the nomenclature be, etc., where the auto business can then demand a valuation that's suitable to the auto business and not be suppressed in any way or boosted in any way by the valuations of the other business, and then you just have a holding company or an investment company that owns the stakes in all of this, and you don't particularly care how the share price of that company does. So that's one way to do it. The other is to see if you want to narrow your portfolio. The flip side to that would be the question, would you look to expand your portfolio either? So all of these questions, Stephen.
See, for us, it's more around the basic question is, can we create value? If we can create value, it's about how can we communicate it then in a way that people understand that. Spinning out a company or not in some ways is an artificial step. It essentially tells us that we have not been able to communicate that value clearly. The reason it's together because there is greater value that is created. So that's part of our challenge. And as you ask about, are we getting into new areas? I think the question will be first, can we become much bigger in areas we are in today? We're in a vast variety of areas. Yes, there may be one or two things we would look at, but at this point I wouldn't say that we're going to go out and look at a lot of new things. I think it's more about driving scale in businesses that we are in. And as we do that, that will enhance more value for our shareholders.
All right, let's turn to how trade is setting up for today. Agam Vakil is joining me to tell you all about that and also to tell you what's happening in the futures and options space. Agam, it's been a few days of consolidation, shall we say. How are we looking at the start of trade today?
Well, Alex, there's some sort of weakness that has set into Indian markets. And really, I reckon a lot of traders are waiting for some amount of short covering to come through. Whether or not that comes through is, well, something that we will know eventually, but for now the SGX Nifty is currently flat, but we do have weakness across Asia. So let's wait and watch as to how that and what that means for the opening. Now, as far as yesterday is concerned, we did see another 0.5% cut for the benchmarks, but that was not the case for when it comes to the broader market indices. The small cap and mid cap indices remaining largely flat. The banking indices did see pressure, specifically the Nifty Bank. Why? On account of a handful of private sector banks which were under pressure, specifically Kotak Mahindra Bank in this case. But let's move on and talk about your ADRs, which were under pressure yesterday and they are under pressure today. Specifically Tata Motors is worth a mention. So, besides that, we don't have too much to go for. Infosys advancing by around 1.8%. Fund flows, we saw selling from FIs and DIs, not too much, but selling all the same. And when it comes to your contributors, HDFC Bank, Kotak Mahindra Bank and ICICI Bank, as I was suggesting, were three big banks which were weighing down on the private, or rather the Nifty Banking Index. We had no help from the IT sector, even though it did advance in yesterday's day of trade. But what about futures and options then? Let's pull that out as well and take a look at how things are coming through. And we are seeing further unwinding in the Nifty futures. The Bank Nifty futures saw fresh shorts considering an increase in open interest. We are also looking at about a 500-point range based on options open interest between 12,000 and 12,500. And yesterday what we saw was a little more writing around the 12,100 and 12,200 calls, as one might expect based on the change in open interest. There you have it. Those are the two bars out there. Moving on to, your VIX, that rose even further on expected lines. The Nifty put call ratio also came off to around 1 as against 1.07. So at an exactly neutral level where you have equal number of calls and puts in open interest. In terms of stocks, we are watching for PFC, Oil India, Indian Oil Corp. Though I suspect that we could see a little bit of a rally for the oil and gas sector because we have seen a sharp drop in crude overnight. And in terms of stocks which saw unwinding, let's pull that up as well. We are seeing United Breweries, HCL Technologies and Balkrishna stand out in trade. But Alex, I reckon today may very well be about oil and the kind of, decline that we've seen, and the positive effects possibly, hopefully, for Indian markets.
Thanks so much for that, Agam. All right, Somit Sarkar is joining me now to tell you all about the stocks in news. Somit, good morning. What's on your list today?
Good morning, Alex. I'll start off with the earnings that came in post-market. Firstly, RBL Bank, the results were below estimates. The net interest income, while the net profit missed analyst estimates, while the asset quality of the bank worsened. Now, the loan growth stood at nearly 20%, while the net interest margins came in at 4.57%. Slippages dropped to 1,048 crore rupees, while out of the 1,800 crore of stressed assets identified earlier, 1,500 crore have already slipped according to the management. Raymond, the revenues were up 12.5%. EBITDA came in higher by 33%. Margins came in higher at 10.9%, while the net profit of the company jumped nearly 5 times due to the sale of Thane land in the current quarter. Net profit ex the Thane land sale is down nearly 4% compared to last year. However, the company's debt also reduced by nearly 415 crore rupees in the current quarter. CR, now the company reported an operationally strong quarter as the benign commodity prices benefited the company's EBITDA and the gross margins. Revenue growth was benefited by high exposure to two-wheeler and passenger vehicle segments, while a higher interest cost and depreciation did impact the company's net profit in the third quarter of financial year 2020. Credit Axis Grameen, the net interest income was up 35%, net profit was higher by 8%, while disbursements during the quarter increased 69%. However, the NBFC's asset quality weakened as the GNPA stood at 0.85% as against 0.52% in the last quarter. However, the company's profitability was boosted with improved cost to income ratio. Ujjivan Small Finance Bank net interest income was up 52%, while the net profit jumped nearly 98%. However, the NBFC's bank's asset quality did weaken in the third quarter. AU Small Finance Bank, the strong results as net profit doubled and asset quality improved in the third quarter. Loan asset under management grew nearly 37% compared to last year, while total deposits increased by 63% compared to last year. In other stocks to watch, firstly Cipla, because US FDA has declared the Goa plant as OAI. Now, company does not believe that this will have any material impact on the US business of the company, because Goa plant accounts for less than 2.5% of company's consolidated revenues, and plant has already received nearly 12 observations in the form 483 earlier. Piramal Enterprises, because they notified that the rights issue was oversubscribed nearly 1.14 times, which was closed on January 21st. UPL, because they clarified that the IT department is searching the offices and departments of various departments of the company, while MRF said that they have partially commissioned the phase 1 of its greenfield unit in the Gujarat.
All right, thanks so much for that, Somit. Those are all stocks that are likely to be active in trade today, and you should watch out for them. But let's talk about the big earnings that came post-market hours yesterday, and start with Larsen & Toubro, which missed its estimates in the December quarter as order execution remained muted. But we were speaking about this with Darshan, and Darshan is joining me now. The order inflow growth guidance, they've maintained that, Darshan. What are the key numbers to watch for?
Yeah, so overall the top line is only a miss. We were anticipating a 10% growth that will come in. That's grown by almost 6%. The EBITDA has grown by 10%. The profit has grown by 15%. So overall, if you're looking at the overall financials, yes, it's come in below what we were anticipating. A couple of factors that we need to watch out for. Firstly, what impacted the EBITDA? The employee cost was much higher this time around. The sales and selling and distribution cost was much higher, and that impacted the margins of the company. On the profit front, other income was lower, higher finance cost this time around, and tax rate was much lower, and that is something that impacted the profits of the company. As far as the order inflow is concerned, it was quite surprising. They've done 41,578 crores of order inflow that is there this quarter, but that puts in a tough task as far as the guidance is concerned, because they've maintained the guidance on the order inflow front at 10 to 12%, which means in the fourth quarter they will have to do anywhere between 66,000 crores to 70,000 crores of orders to meet that guidance, in a tall task when the environment is extremely weak. Even on the revenue front, they said that the guidance is maintained at 12 to 15%, and in the first 9 months they've done 10% top line growth, so that also becomes difficult. Overall, a lot of brokerages have cut targets and estimates for L&T post this number.
All right, thanks so much for that, Darshan. Let's turn focus now to the banking space. Axis Bank also was the other nifty major to have reported earnings after market hours yesterday. The profits missed street estimates due to a one-time rise in staff costs. Now, asset quality remained largely stable, although slippages saw a rise sequentially. Vishwanath Nair takes us through the quarter gone by and also the management commentary post the numbers.
In the October-December period, Axis Bank reported a 5% increase in its net profit, which rose to about 1,757 crore, which is just shy of the estimate that Bloomberg analysts had about 2,139 crore. Now remember that this lower growth in profit is primarily, according to the bank, is primarily because of a one-off event that happened last year. In the same quarter in 2018, the bank had witnessed a large recovery on a steel account, because of which the growth numbers are looking less. According to the bank, the operating profit would have grown about 22% if you take that one account out of the entire equation. However, Axis Bank did stumble upon some of the asset quality issues which have been somewhat of a feature in Axis Bank results in the past. So for the third quarter, that is the October-December period, Axis Bank reported about 6,200 crore worth of slippages, which is basically accounts that are slipped into the gross NPA category. About 1,000 crore of the 6,200 crore came from a single account, and that is primarily on the investment book side, where in a housing finance company, the bank had invested certain money in the bonds that were issued by this housing finance company, and that has now slipped into NPA. Apart from that, a vast number of the entire slippages came from the BB and below rated book. Now, according to the bank, that specific book has gone down to levels below 3% of their corporate lending portfolio, and those are levels that the bank had seen last 6 years ago, after which, of course, some of the stress issues started with Axis Bank. So, according to the bank, the return to some of the more benign levels in the BB and below rated book is a positive, and therefore future slippages will be lower. However, the management at the Axis Bank did warn that they cannot be definitely sure, because there are surprising events that do keep happening within the economy, and with the current growth rate in the economy, there is a good chance that there might be certain accounts which slip into NPA, and that is not something that the bank can actually estimate beforehand. Alongside, the bank had also said that its SME portfolio has not grown at all during the December quarter, and this is primarily because the bank has been very consciously bringing down its supply chain financing business, which essentially finances SMEs who are in the auto sector. So that business has been coming down. Apart from that, of course, there is the utilization level within the SME borrowers has also been dropping about 8 to 10%. According to the management, in the current macroeconomic environment, it is not wise to go gung-ho after the SME business, and it would be wise to take baby steps to try and bring growth to at a manageable level and manage the actual stress in the the SME loan book. Apart from that, of course, the overall growth was supported by a spread out growth over the retail loan portfolio, largely coming in from home loans, auto loans, as well as some of the more unsecured portfolios. Now, according to the bank, they have been lending consciously only to their own customers, and thereby they have a better control over the chances of default in these loans, and therefore they are not seeing any stress in the retail portfolio that some of the other larger private sector banks have been seeing.
All right, that's all you need to know going to trade today, but do stay tuned. We're clearly going to be talking about a lot of things that will interest you over the course of the day, and you'll also find a lot of coverage of Davos and the markets, as well as everything in business on BloombergQuint.com.